Namaste, Sat Sri Akal and Adab. This is Sunil Jhaveri, your host and host, also known as MisterBond in the mutual fund industry. Welcome to One-on-One with MisterBond in conversation with Niket Shah, Star Fund Manager of Motilal Oswal Mutual Fund, who is managing Midcap Fund of Motilal Oswal. Welcome, Niket.
Thanks, Sunil.
Thank you so much for attending this show and this session. What we want to do, Niket, here is not only talk about Midcap Fund, your Midcap Fund only. I want to guide the investors on a lot of global macro factors also, so that they understand that we are not totally decoupled from the rest of the world.
Absolutely.
Because the story and the narrative is that India is decoupled story, it's insulated, anything can happen in the world markets, but we will not have any impact. I think that's a wrong narrative. I'm sure you'll agree to that.
Yeah, pretty much, yeah.
Yeah, so we'll make it interesting for the viewers. What we are going to discuss is the global macro factors, and then finally we'll bring it down to the Indian macro factors, and then how do you manage your mid-cap fund, which has done phenomenally well.
Absolutely.
You've beaten the peers also, and you've beaten the benchmark also by a big margin. So that's really commendable. So let's begin with the first global macro factor, which according to me is the dollar index. If you remember, dollar index had touched 103 in March 2020. That was when the flight to liquidity happened, just around the COVID time. It touched a low of 90 rupees, in dollar index terms, in somewhere in May 2021 when Fed started printing money, dollars.
Correct.
So, but now it touched a high of 114 in September 2022.
Right.
That's when again flight to liquidity happened, and practically all the asset classes corrected, including cryptos, including equity, including real estate, etc. So that's what happens is when dollar index goes to a high, the money gets transferred into dollars and all the other asset classes get affected.
Absolutely.
Currently we are at 101 or so. What do you expect in terms of how do you read this particular macro factor in terms of should we be expecting some inflows into the emerging markets, including India? Is that what 101, 102 reading of dollar index means to the Indian investors?
Sure. So I think, Sunil, there are 2 points. One is I think the near term thing, because the situation is extremely fluid, right? And in the near term, I think a lot of things would depend on how Fed really moves the interest rate and what is the assumption of Fed on inflation. Our view is that we are pretty much coming towards the end of the inflationary cycle. Primarily, one is also because of base effect, and second is the measures taken by the Fed in the last almost 6 to 7 months are actually starting to see impact in terms of lower inflation rate. When inflation kind of comes off, it also helps the Fed to bring down interest rate, because inflation also leads to some bit of slowdown.
Correct.
And we are seeing some early signs of slowdown in US at this point in time, and there's obviously a widespread expectation of a recession. And globally, we have seen recession. None of the recessions in the past have lasted for more than 12 months.
Correct.
So hence the curve also is inverted to that extent. So our view is that if inflation is expected to come down, and hence the focus of the Fed will move back to growth. And you will see Fed kind of start cutting rates towards the end of the year, which means that the more money will start coming back to emerging markets, and the dollar index hence will start moving back closer to 90.
Sure.
So our view is that in the near term, we might be in the range of 102 to 105, but we eventually will move back to 90, 95 levels, at least in the next 12 to 18 months.
So that's when we should be expecting huge inflows coming back into the emerging markets, including India, because India is a growth story by itself, even otherwise.
Absolutely.
Perfect. Now, how do you read inflation? US inflation had peaked at 9.1 in June 2022, has come down to almost 6%. And hopefully in May, when the Fed meeting will happen, FOMC meeting will happen, do you expect that there will be a pause in the rate hike cycle by the Fed? That's number one. But the unfortunate part is that OPEC had cut down on the crude oil productions, and that has spiked the oil prices again. So it had touched a low of $70. Now it's gone back above, I think, $80 plus. So will that have some impact bearing on the inflation going forward? And will that curtail Fed from not pausing but continue to increase the interest rates?
So I think the Fed, in our opinion, will do one more hike in the immediate meeting. And the primary reason is that if you look at within inflation, if you look at the core inflation part, still continues to remain elevated.
Correct.
Right? It's still not coming off.
Same is the case in UK also.
Exactly. Same is the case in UK and other geographies. So our view is that the Fed might take another 25 basis point hike, and then will take a pause for at least a few months before it starts seeing inflation numbers kind of coming off. Only when you start seeing inflation coming off will the Fed really start moving in terms of cutting rates. But we don't think it will start cutting rates in a hurry. It might be closer to the end of the year or early next year. But you will see Fed taking one more hike primarily because of the core inflation part, which continues to remain, fairly elevated at this point.
So rates will remain elevated for
at least 6 to 9 months for sure. Absolutely. Yeah.
Correct. Another indicator of imminent recession in US or any other country is basically the inverted yield curve, 10-year versus the 2-year, and which has been in the inverted yield curve territory as far as US is concerned for quite some time now.
Right.
It had gone up to almost 107 basis point, currently maybe at 67 basis point or so. But that shows that the recession is round the corner, maybe 12 months or 18 months down the line. So if that happens, the Eurozone being in a recessionary trend, the China being in a meltdown kind of a situation, how far do you expect that India can drive the world story?
Yeah, so I think if you look at curve from a global standpoint, yes, it's inverted. In India also, if you look at last month, we had a situation where we had a slightly inverted curve if you look at the longer range, like the 30-year and a 40-year paper versus a 10-year paper. But I think now we are back to normal. I think it's also to do with some bit of expectation on inflation, right? The markets believe that inflation will come off over the longer term, but it's going to be transitory in the near term. Then you will have that inverted curve being kind of played out. And obviously the recession part that you highlighted. But I think some of these things don't last beyond a year. If you look at historically, we've not seen more than a year of inverted curve being there, at least in the last 20 years, right? So we might see an inverted curve today, but in my opinion, as the inflation kind of gets more normalized, and as we realize that, US might not sustain the recessionary environment for a longer duration of time, you will see rates coming back to normalcy. But you might see this phenomena continuing for another 6 months.
Sure. Declining earnings, EPS in the S&P. So, there is always a lag effect as when the interest rates rise, and then there is a corporate balance sheets which will have a lag effect, etc. And that's what is being projected in the earnings per share decline on the S&P 500. Something similar is being played out in the Indian context also. So what do you expect in terms of the Indian context versus where do you see the US markets?
So I think if you look at in terms of earnings growth, and again, kind of highlighting what's happening in US market as well, right? I think both of them were factors of liquidity which really drove earnings growth across the world, not only in US, UK, even in India. And we are seeing as tightening happening more and more, even in India, when we look at the liquidity system in India, its liquidity continues to remain extremely tight, which essentially means that we are going to see substantial amount of slowdown in multiple sectors, right? And the early warning signals were actually visible from the last quarter itself.
Absolutely.
We believe those signals are actually getting more elevated as we kind of speak, right? So two things are happening specifically to India question is, one is that if you look at in the past, the interest rate, when RBI used to increase interest rates, the banks never used to pass it on completely. Now it's all linked to repo, right? So you have an immediate pass on of interest rate. And hence, if you look at the lower pyramid of India, typically will actually have a double whammy. One on the inflation side, second is on the interest rate side. So they get hit on both sides similar at the same time. And hence, we will actually see a situation where we will see a lot of volatility now going forward as well, because on inflation, the lower strata gets impacted. And again, you have another round of outflow from an interest rate standpoint. This brings down demand dramatically in the economy.
Absolutely, right? The consumptions.
Absolutely. And the vice versa will also kind of start playing out once the interest rate cycle kind of moves the other way around.
Correct.
So I think we will see another 2 quarters of extremely bad corporate earnings. From more than 20% growth, I think our expectation is this year we will end with slightly closer to 8 to 10% kind of growth on NIFTY earnings. And we will see some pickup again happening next year because of one, interest rate coming down, which actually, kind of helps you to significantly drive back demand in the economy again. So again, next year we will see kind of growth in the corporate earnings moving up. But this year, in my opinion, I think Street will have to go through earnings downward cycle on the Nifty as well as mid-cap index earnings.
So it's not, everything is not hunky-dory the way things are being projected as far as the Indian
Absolutely.
context is concerned. So what we are trying to just guide the investor is not to panic in certain situations, but at least be reasonable in terms of your expectations, what you should be having from the Indian context in terms of the markets in the in India per se, based on the global macro factors, which what we have just discussed. Now coming to India's valuation versus the MSCI Emerging Market Index, India was at very expensive valuations, almost 134% premium to the other emerging markets. Now it has of course come down because India has also corrected in terms of the markets. Where do you see India in terms of the emerging market index in terms of the valuations currently? And are we reasonably valued, cheaply valued, or still expensive in terms of the rest of the world?
So I think from a valuation standpoint, in my opinion, India will continue to trade at slight premium to other markets. And the primary reason is multifold, right? So major two reasons I would say is, one is if you look at debt to GDP for most of the countries, right, is in north of 250%.
Absolutely.
For India, that's not the case
That's
at
not
all,
the case.
right?
It's below.
It's below one. It's close to 150 now,
Right.
right? And it's obviously moving down by the year. If you look at the earnings growth, right, India still continues to grow at north of 6 to 7%,
Correct.
right? And I believe that if you look at the other important part, which today no one is focusing, which is the current account, right? Deficit, right? And if you look at the kind of growth that we've seen on the export side, right, and the import side as well, right, we are seeing a situation where because of services growth being extremely strong, right, India's current account deficit is also narrowing. This means that the stability in the currency will also start coming in,
Correct.
right? Which haven't actually happened in the last 20-25 years in India. So this, in our opinion, is actually a very important landmark where in the next 3 to 4 years, as most of the PLI benefits start kicking in, as most of the services growth start kicking in, you will actually see a situation where your current account deficit numbers will be far more lower and your currency is actually much more stable. In our opinion, if India starts seeing inflows again going forward, we might see currency actually moving back to 78.
Wow.
Which is actually more like an anti-consensus call at this point in time.
Oh, okay. And plus, I think somewhere I read that the gold imports have also come down substantially as far as Indian context is concerned. And plus the crude oil prices, which have come off, hopefully they'll remain between.
They're still at 82. If it comes down to 50, then we might actually have a surplus kind of situation now. Yeah.
So that will be very good as far as the
Indian economy is concerned. Absolutely.
Perfect. Now let's talk about the Indian valuations, and then we'll talk about the mid-cap fund which you are managing.
Sure.
Right? So the SEBI definition of mid-cap schemes is that minimum 65% should be in the mid-cap space, which is the 101 to 250th market capitalization of stocks. So that's the SEBI definition. Minimum 65% in 101st to the 250th company, and balance at the discretion of the fund manager. And we will discuss as to what the fund manager, Niket, has positioned his mid-cap fund. Is he overweight on large cap or small cap in that 35% segment? Now let's talk about the India's valuation, which have cooled off substantially, but earnings have grown. So if you see the valuations from October 2021, when the price to earning, price to book, earnings per share, say of Nifty 50 was at 28, 4.63 and 60.55. Currently, because the markets have cooled off, the price to earning has come off to 20.80, 3.72 of price to book, and the good part is that earnings have grown.
Yes.
During this period. Something similar is happening in the mid cap space also, in the small cap space also. So where do you see there is good value in terms of the Indian market space, large, mid or small cap?
So I think if you look at the space of India, right, which is large cap, mid cap, small cap, I think if you look at over the longer duration, the mid cap has been the best performing index if you look at from 2004 till now.
So let me show that data also. So if you see historically, mid caps have outperformed large cap and small cap. So if you see last 10-year and 15-year data, if Nifty 50 has delivered 11.77 or 9.04%, mid cap has delivered a whopping 14.90 and 11.08 versus small cap of 10.87 and 6.02%.
Absolutely. And it also kind of collaborates with the fact that mid caps actually grow at a faster pace as compared to large caps, right?
Because they are the future large caps.
They're the future large caps. So actually mid caps are actually in a very sweet spot because of two reasons. One is that they have potential to become future large caps. And the second is that unlike small cap, which are much more fragile, right, to economic cycles, mid caps aren't so much fragile, right? Because typically, if you look at mid cap, 101 to 250 company, the 250th company will be closer to 15,000 to 17,000 crore market cap,
right?
Which essentially means that they should have a profit of north of 300 to 400 crores,
correct?
Which means that they would have seen multiple cycles in terms of slowdown and so on and so forth, and hence they are much more better equipped.
They're more mature companies than the small
caps, right? So it's actually in a sweet spot where the downside risk is also limited, but on the upside, they actually participate much more faster than the large cap in terms of growth and hence in terms of returns as well.
Sure.
So if you look at the valuation part, yes, the valuations are stretched clearly, at least by about 10%. If you look at on the NIFTY as well as on the mid-cap index, as compared to the longer-term averages. In our opinion, two things will happen. We will see some earnings cut happening, right? At least in the next 2 to 3 quarters.
Then the price to earning and price to book will actually go up.
And hence, we also expect the markets to kind of come off a bit, at least in the near term, which is 6 to 9 months. What happens is when you time correct over a period of at least 2 to 3 quarters, right? Essentially, when you start looking at 25 basis, you will actually start seeing markets coming very close to the longer term averages, which again makes much more lucrative sense to really go back.
So long term average of a Nifty 50 would be somewhere between 19 to 20.
Closer to 18 actually.
Closer to 18.
Closer to 18 times is where is a sustainable level to go and invest from a longer term return standpoint. So our view is that you will actually see earnings growth this year, but markets won't go anywhere, which essentially means that the multiples will keep coming down to those levels.
Correct.
Right. And closer to, maybe the second half of this year is where you will start seeing rally coming back in markets, is where you actually see multiples again kind of getting expanded.
So what I hear you say is twofold. One is that markets will come off. So the price to earning and price to book, etc. will come off.
Yes.
Because of that market correction. So the only way to markets to deliver returns or come back to that sanity levels or the average levels is either the earnings have to grow or the markets have to correct.
Absolutely.
But because the earning growth is not expected to be as much as what it used to be because of the rate hikes, etc., which has a lag effect.
Correct.
So for that reason, you expect that the markets will have to come off a little bit from the current levels.
Absolutely. And we believe that the reason why next year earnings will be much more higher than this year is by next year you will start seeing the benefit of the interest rate cuts which will happen globally, right? Which again kind of drives back corporate earnings growth and liquidity in the system.
Absolutely. Now let's talk about your own mid-cap space. So as on 31st of March 2023, your mid-cap space was underweight large cap, 6% versus 7% in Nifty mid-cap 150. Underweight in mid-cap 79% versus 91%. If the Nifty mid-cap is 150 is your benchmark, then your portfolio is 79% versus 91%.
Correct.
But you are overweight in small cap, 10% versus 2% in Nifty mid-cap 150.
Right.
So some rationale behind why small cap overweight and why underweight in mid cap and large cap.
Sure. So I think if you look at the small cap has actually corrected much more sharply as compared to the large cap and the mid cap side of the market. One important thing in small cap is that you essentially have to buy during the crisis.
Correct.
Right. So that you actually can able to see the entire gains when it comes next year. Right. And we typically believe that if we get a bottoms up ideas in the small cap space, we would essentially prefer small cap over large cap, primarily because of higher returns that we expect to give to our unit holders. In our opinion, small cap is at least at a level where we don't see dramatic downside from current levels. Right?
Okay.
We might see about 5 to 7% cut, but I think it's again now getting down to extremely stock specific discussion. Because initially what used to happen last year, a couple of years back when mid caps and small cap went off the roof, at those levels, I think valuations were extremely expensive across the market, right? It's very difficult to get a small cap idea at that point of time. With most of the small caps getting corrected by 30 to 50% range, we see a lot of opportunities coming in some of the interesting small caps where we believe they have potential to give us 2 to 3x returns in the next 1 to 2 years. And that's exactly where our focus is right now. As we believe that we might be in a, as I highlighted, we might be in a 3 to 6 month kind of a corrective phase. We will use this opportunity to move more and more to small caps to ensure that when the next cycle really comes, we are rightly positioned to give the maximum return to our investors.
So what I have seen, and for the viewers also, what we have seen is that small caps, actively managed small caps have performing much better than the benchmark.
Absolutely.
Versus the large cap and the mid cap space. So that's where the fund manager's role comes into play in identifying the right stocks and picking the right stocks. So rightly said, the small caps have corrected. So that's the reason why you will be overweight in small caps versus the benchmark.
Correct.
Now, mid-cap allocation is widely diversified under different sectors, overweight on IT, chemicals, consumption, auto ancillaries and industrials. And are you taking a contrarian view on IT? You have seen what had happened in the IT stocks just a few days back. So,
yes.
So why are you overweight in IT? Is that because of the correction which has already happened? Is that the reason?
Yeah.
Or is it a contrarian call?
Absolutely. So I think if you look at the fund in the last 2 years, which has benefited, I think 2-3 things have really gone right for us, right? One is our sector selection has been absolutely spot on. And within that sector selection, stock selection has been absolutely spot on. For us, if you look at in the last 2 years, post 2021, somewhere close to October 21, we actually went dramatically underweight IT when IT stocks were at peak.
Oh.
Right, and we actually could able to save the entire fall in IT stocks, right? We were completely unaffected by that. As we look at today, we look at demand being postponed in US, right? I mean, if you look at most of the companies in terms of the results and commentary, most of the companies have highlighted that demand continues to remain strong, but because of uncertainty in some of these markets, the order inflow has kind of got a bit delayed. Second, I think important point is that the valuations of IT company had gone off the roof, which are now getting much more normalized.
Correct.
Our opinion is that next year is going to be a year of IT.
Okay.
Right? Because of two things. Once, I think these uncertainty, which is like a 3 to 6 months uncertainty, which everyone has been talking about, kind of goes away. You will see most of the order flows coming back to IT companies with a vengeance. And we will see growth coming back in some of these IT companies in a big way. Again, within IT, we have been focusing very much on different stock selection, whether you're playing the ER&D part of it or whether you're playing the IT services part of it. So we actually are playing both of them. We are playing a large part of our allocation in the mid-cap indexes to our ER&D companies, which are focusing more on auto, which have nothing to do with what's happening in US banking system or what's happening with US retail. Because auto as a category is actually spending big time today because of, the EV migration, which everyone is seeing.
Correct.
And we believe some of the auto ER&D companies where we have invested essentially are actually going to see substantial earnings growth, which are not going to mirror the slowdown that other IT
within
companies
IT also there are segments
which we actually have to focus on. So the ER&D part is again rightly positioned. Now within the IT services where we are adding weights, our view is that most of these slowdown is extremely transitory. Right? It's not a sustainable or not a structural change in the economy. Right? So we are seeing a situation where IT stocks have corrected. Valuations have become much more reasonable than what they were in the past. The quality of earnings is extremely strong today. The balance sheet of most of these IT companies are extremely strong, and hence we believe that they're actually rightly positioned with very limited downside.
Correct.
From the current levels, and a potential to actually see significant amount of.
So there will be some volatility based on the IT sector which you have invested in, but you will have to ride that volatility.
So we typically, by design, we typically like to invest a quarter before the earnings bottoming out.
Okay.
So our view is that this quarter, we have seen some earnings downgrades in IT. We might see some small earnings downgrade in the first quarter, and that's about it.
What about the consumption side? Because the consumption, we expect that the consumption story is likely to be affected with the raise in interest rates which is happening.
Yeah.
So again, is it something similar what you're playing with IT?
Absolutely.
A quarter before the...
Exactly. So we have started to go over a bit on, consumer discretionary, because our view is that when interest rate tops out, the demand on the consumers bottoms out.
Correct.
Right. So you will actually see a situation where if interest rate starts coming down, you will see demand kind of starts coming back. The other important part is that we go into elections next year, which means that there will be a lot of money which will be spent, right? And that essentially also brings in the consumer demand back up again. Right?
Correct.
So we believe that consumer discretionary demand destruction, which we've seen in the last 1 year, is very close to bottoming out as well. And we believe that has room to surprise on the positive side as far as earnings growth is concerned.
So your portfolio is positioned well to capture the consumption story and the IT story.
IT story for next year.
Maybe a quarter ahead.
Yes.
But you expect this to play out
in the next year. Absolutely.
Great. Portfolio size matters is what you've been saying, and you are somewhere in between. So if the highest portfolio is, let's say, 30,000 crore plus in the mid-cap space, the smallest portfolio I think is somewhere around 71 crores or something like that.
Yeah.
But you are in between at about 3,800 crores or 4,000 crores, close to that.
Right.
So how does the portfolio size matter? And if that matters, then what happens when your portfolio size also grows to unsustainable levels?
So I think portfolio size only matters from an entry and exit standpoint, right? Just from a liquidity standpoint. Otherwise, I don't think there is any detriment to performance or if your size of the portfolio goes to say 20,000 crores, it's very difficult to manage performance at that time. I think if we go to 20,000 crores AUM in the next 3 to 4 years, we might have to change our strategy in terms of number of stocks that we own.
Right.
From 30 stocks, we might have to diversify a bit more because it's too much concentration in a particular name. And in that case, we might actually move to say a 40 or a 45 stock portfolio, but that's much more later. At this point in time, we don't believe we need to go more than 30, 32 names at this point in time. If you look at most of the returns in the last 2 to 3 years that the fund has actually been able to get has primarily been on bottoms up ideation. Right?
Okay.
Some of the stocks in our portfolio become 5x, 6x, right? Where our weights were also very, very high. And hence, it also shows that India as a market is a market which is extremely under-researched on the mid-cap side.
Oh.
Right? And reasonably over-researched on the
only
large-cap
150
side.
stock, but it's still under-researched.
Still under-researched on the mid-cap side.
Wow.
Right? And our job is that while we are fund managers by designation, but we are analysts at heart. So we do believe that our job is to keep finding out the next winners, right, in a dynamic country.
How difficult it is for you to identify and beat and generate alpha, because you're limited to that 150 stocks.
Yes.
So we've seen something similar happening in large cap space.
Yes.
Because of the 100 stocks, the fund managers are not able to beat the benchmark.
Right.
How difficult is it for you to beat the benchmark on an ongoing basis with a limited stock basket of 150?
So I don't think it's very difficult to beat the benchmark, with 100. So 150 doesn't mean that it's a constraint to beat, because you still have the balance
35% into large and small cap.
You can have full small cap or you have full large cap.
Correct.
Right? So you always have the 35% to bring the alpha.
Okay.
In case if you're unable to beat the benchmark within that 65% range.
Sure.
Right? So in our opinion, it's not very, very difficult. It's completely dependent on idea generation and how within that 150 names, there are companies which have become 4x or 5x.
Wow.
Right? And there will be companies within that 150 range which will become 3x from year on as well after 2 years from now.
Now let's talk about the active management. What is the criteria for your exits? Because I see this data is very interesting data where you had multi-baggers of 5 times, 10 times, etc.
Right.
And then you sold off those multi-baggers, and after that those same stocks have corrected dramatically.
Right.
What prompted you to do that? Sell? What is your internal formula for exiting out of some of these stocks?
So I'm a strong believer that buying a particular stock is very overrated and selling skills are extremely underrated in the industry, right? I think the most important part is selling and exiting, and we kind of keep thinking about how do we look at
Unfortunately,
exiting.
no fund manager talks about selling.
Selling, right? We only think about what to buy,
what to
right?
buy.
Never to sell. I think for us, for me specifically, and as a house as such, we look at selling primarily due to 2 reasons. One is when the valuations are very, very expensive. And second is where we see earnings downgrade cycle beginning to start, right? Which also reflects to the first point, right? For example, if your expectation is that a company which is supposed to report an EPS of 100 rupees and your internal research says that instead of 100, it will be 80 rupees.
Okay.
Then automatically the multiple will start looking expensive. And that's when we really go and look at, moving out of a stock. So that's reason number one. The second is if there is any structural change in the industry dynamics, right? Because of multiple factors, macro, government policies, external factors, as well as internal factors, right? A top class management, a professional management leaving, so on and so forth. So there are multiple other factors which typically results in an exit. So, but I would say the large part of the exits will always be under the first reason which I highlighted to you. And second reason which will be very, very rare.
Sure. But very interesting data, because I have not seen this data being disclosed in many of these fact sheets.
Yeah. So the reason in some of the stocks that we've kind of highlighted here is, again, valuation is very, very expensive, and we could clearly see that earnings upgrade cycle is coming to an end, and you will see earnings downgrade in some of these names.
And it's reflected in the underperformance thereafter, after you sold off.
Yeah, absolutely.
Perfect. Now, performance versus benchmark versus peers. I think you have recently 3 to 6 months, you are underperforming the benchmark and the peers. But prior to that, there is a huge outperformance. If you see the 1 year, 3 year, 5 year, and since inception also.
Right.
But as they say, those who were top ranked over 3 year period, any 3 year period, generally they are the bottom in terms of performance over the next 3 years. How will you avoid that?
I'll break that jinx this time for sure. So I think one important point to ensure that how do you break it is portfolio should never remain constant or static, right? Because essentially businesses are all about cycles, right?
So it's not buy and hold only.
It's not buy and hold for eternity, right? So you have to do buy and hold, but cycles globally have become much more shorter, right? And same is with India as well, right?
Correct.
Cycles are very, very short. And hence you actually have to buy in crisis and sell when the whole world wants to buy.
Absolutely.
If you're able to do that successfully with bottoms-up skill set in terms of stock identification, then I think broadly you will end up with the first quartile. Now, there can be, 1 month is very short duration that we also don't internally kind of think about. But what also happens is that sometimes you went overweight on a particular sector, right? Like IT is a classic in case, right? Where
that
we are
may have maybe dragging it down right now.
Pulled it a bit down, but I think we also internally believe that the best of the IT will only start happening post first quarter. But there are some times when the fund becomes larger, you actually get some stocks at a far more reasonable valuation at crises like this. But the performance of some of these businesses will only effectively start coming up in a quarter down the line.
Right.
And at that time, we will actually cover for some of the small underperformance that we actually have at this point.
Sure.
Right? But if you look at the longer term picture, this is similar things have actually happened with us 2 years back when we look at restructuring our mid-cap fund. We actually got into sectors where everyone was underweight, right? And we actually got into stocks where no one used to own it. There used to be, like for example, if you look at Tube Investments, right? It used to be an auto-line company with virtually no coverage on the street at that time, right? There was no sell side, one or two maybe, but not widely covered, right? And at that point of time, auto was going through a rough weather, right? Because obviously chip issues were very, very elevated. And hence, I think the production issues were there at the auto and companies.
Correct.
But yet, we kind of were able to find out a name within the auto space, which has actually give us 6x return in the last 2 years, right?
Okay.
So the idea is that now when we bought, right, essentially stock didn't do anything for 3-month period, right? But most of the growth then started coming up in terms of margin expansion and so on and so forth. So we like to buy things a quarter ahead of the curve, and in that period there is a possibility we might have a smaller underperformance. But then I think as the flavor of the sector comes back, we will enjoy the fruits.
So for the audience, what Niket is saying is basically, even though they have been top quartile performers, they will continue to perform going forward also with the kind of stock selection and the active management. So that myth that, the top performer may become the bottom performer going forward may be broken with Niket and his expertise. So Niket, now coming to the value-based investing.
Yeah.
So if you understand this and you wanted to ask me a question on that.
I just wanted to ask you a question. Like if I mean, this is the data which actually even I saw and even I was stunned at how have you able to deliver phenomenal double-digit returns for your investors versus a single-digit return that the fund would have evaluated or given over a period of last 1 year. So would love to hear your thoughts that how are you able to manage this in a dynamic environment?
Sure. So what I believe in is that first and foremost, downside protection. Our investment philosophy is based on downside protection and being in the right asset class at right valuation.
Right.
So unfortunate part is that buy and hold, sip karo, bhul jao, etc. These are the mantras which are becoming redundant and ineffective. And that's when volatility creeps in, then the investors become irrational. So I want to identify and bracket investors not as conservative or aggressive, but as rational or irrational. So rational investors will invest based on the asset allocation theory. So my value shastra is a product which we had designed, where my algorithm, which is like a Motilal Oswal value index, will say 50% in equity at the time of investment and 50% in debt, for an example. If my algo was giving that trigger, 50% of the money in this case from September 2022 to now, if markets have delivered zero return, ours performance is almost 12%, as you can see.
Yes.
So what we would have done in September 2022, our algo said 50% equity. We would have invested in your mid cap 50% of the money.
Right.
The balance 50% was in liquid fund, from where we would have done 3x transfer. So 60 lakhs divided by 60 installments, 1x is 1 lakh rupee.
Okay.
When the markets are in the yellow zone, we'll continue to do 3x transfer into equity. And that's what we've done.
Right.
And that's what has delivered this alpha as far as the
so essentially you would have benefited when the markets would have tanked during the COVID period. The returns would really go off the roof.
So that was in the COVID, but this is only a 7-month period right now. We are talking about when the markets delivered no returns, but when the markets corrected, and then we would have still invested at that better valuation instead of investing at one go. So all we are trying to do is bring discipline into the system of the investors and the mutual fund distributor is based on the valuation. If you invest at right valuations, the outcome thereafter will be much better.
This is incredible, Sunil. I haven't seen this. This is extremely incredible.
Thank you so much. Thank you, viewers, for watching this, and thank you, Niket, for being so candid about all the aspects, because we did not want to only restrict our interview to just your mid-cap fund. It was global macros.
Absolutely.
How is it going to impact Indian investors also? So viewers must have a idea as to that the markets are going to be in the volatile zone for the next 6 to 12 months period. Thereafter, as Niket is saying, that the India story will pan out. That's when the decoupling will actually happen, and India will start shining thereafter. Thank you so much.
Thank you. Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.